Welcome to Arena Finance, the voice of personal finance. I'm Rudy Banerjee and I'm here with my colleague IP. This is part two of our series on investments. In this session, we will discuss bonds and certificates of deposits. Here are the topics we will cover today. Number one, introduction to bonds. Number two, why we should invest in bonds and the risks involved. Number three, what are some terms we should be familiar with? Number four, let's get familiar with the different components of bonds. Number five, what are certificates of deposits or CDs? And number six, how do we invest in all these instruments?
Before we approach this topic, here are a few pointers. We'll discuss strategies for long term investing with diversification and lowering the risk of losses and fluctuations. A balanced portfolio of stocks, bonds, mutual funds, etc., are essential for long term investment success. An undiversified portfolio of one or two assets is not recommended. Now, let's discuss bonds. What is a bond? In simple terms, you invest in an instrument issued by a company or government that pays you interest over a certain period of time and the principal is returned to you at the end of the term. For example, you invest $100 at 5% interest for 2 years in company ABC's bond. You receive $5 per year in interest over this term and $100 is returned back to you after 2 years. So you now have $110 at the end of 2 years. Why would you invest in bonds? Here are a few reasons. Number one, capital preservation. When you buy bonds, the principal value of a bond is returned to the investor in full at maturity. This can make bonds attractive to risk adverse investors who are concerned about losing their principal. Number two, income. They provide regular interest payments called coupons that can provide a steady source of income and cover expenses. Hence, it's a great investment option for retirees. Number three, capital appreciation. You can hold a bond till maturity but also sell it during the term. Capital appreciation or price appreciation in bonds can occur when an investor sells a bond before maturity after its price has increased. This increases the bond's total return, which is the sum of its income and capital appreciation. Number four, diversification. We discussed diversification before. A well diversified portfolio reduces risk because if any single asset class like stocks perform poorly, others may perform well. Number five, hedge against economic slowdown. In periods of economic slowdown or recession, investors turn to bonds, particularly government bonds or high grade company bonds, as safer investments. In downturns, investors generally sell stocks and buy bonds. This shift may result in increased bond prices, reduce portfolio volatility, and provide a predictable income to pay for household expenses.
There is a certain degree of risk involved in investing in bonds. Since we are investing in a government or company's debt, we need to know their ability to repay us with interest. Fortunately, there are private companies that do that for us. Bond rating agencies are private companies that assess their creditworthiness. They publish ratings that individuals and investment professionals use to determine the likelihood that the debt will be repaid. They study a company's financials, profit outlook, competition, and economic outlook, and express their rating on a combination of these factors. These are similar to credit ratings for individuals. There are three companies that provide bond ratings: Standard and Poor's, Moody's, and Fitch. Here is the rating scale used by each of them. As we can see, the highest possible rating that a bond may achieve is AAA, which is only bestowed upon those bonds that exhibit the highest level of creditworthiness. As of May 2024, only two companies in the US have a AAA credit rating: Microsoft and Johnson & Johnson. The perception is that the US government bond has the highest rating, but that's not the case. Their bond rating is AA plus. As we go down the scale, it reflects an increased level of investment risk. A thing to know is that the risk increases, a company is obligated to pay a higher percentage of interest as a coupon. For example, a company that has a triple C rating pays 14% interest, while one with AAA rating pays 5%. How the risk is expressed varies across the agencies. For example, bonds graded CCC by Fitch that represent substantial risk and has a high risk of default. However, this is represented by CCC plus by S&P and Caa1 by Moody's. A junk bond is a highly risky instrument that is categorized as BB plus and below by Fitch and S&P and Ba1 and lower by Moody's. They are issued by a company seeking to raise capital quickly in order to borrow money in order to fund their operations or finance a takeover.
Here are the risks of investing in bonds. Number 1. Default risk. Many of us are unaware that most of the bonds are not guaranteed by the government. Instead, they are dependent on the company or issuer. Also, one needs to evaluate the bond rating, as we discussed prior, to assess their risk. Number 2. Interest rate risk. Interest rates and bond prices are inversely proportional, which implies that if the current interest rate goes down, there will be a rise in the bond prices and vice versa. Number 3. Relative underperformance. Over the past 30 years, stocks posted an average annual return of 10.4%, while bonds returned only 6.8% annually. However, bonds have a lower risk and are less volatile than stocks. Number 4. Callable risk. Certain bonds have a callable options where the issuer has the options to call and redeem the security before it matures. So, you'll not be able to get the interest for the full term. Some of these bonds have higher interest rates relative to others, so you may choose them, but check their callability options before purchase. Now, let's discuss the four components of a bond. Number 1. Maturity. This is the date that the bond matures and the principal is returned to you. Number 2. Face value. The face value of each bond, also referred to as the par value or redemption's value, is the amount the issuer promises to pay once the bond reaches maturity. In the US, the face value is typically $1,000 for a corporate bond, $5,000 for a municipal bond, and $10,000 for a government bond. Number 3. Coupon yield. This is the annual interest rate established by bond issuer that doesn't change during the lifespan of the bond. Number 4. Price of the bond is quoted in increments of 132 of 1%. Example, 100-25 equals $100.6875. So now when you see the quotation of a bond, you'll know what that it means.
Here are the four different types of bonds. Number 1. Treasury bonds. They are government bonds issued by the US Treasury. The types of Treasury bonds include Treasury bills, Treasury notes, Treasury inflation protected securities or TIPS, and floating rate notes or FRNs. The terms can be from 3 months up to 30 years. Number 2. Municipal bonds. Municipal bonds are issued by local governments to finance needs of a community, such as the building of a community center or park. There are two types of municipal bonds. Number 1, general obligation bonds that are backed by the general revenue of the issuing municipality. Number 2, revenue bonds that are supported by a specific revenue source, such as income from a toll road or sewer system. The third type of bond is corporate bonds. A corporate bond is issued by a company to raise money for various purposes, such as building a new plant or purchasing equipment. These bonds can be fixed or floating rate, zero coupon, or convertible. Let's discuss these in further detail. Number 1, fixed rate are when the company pays a fixed interest rate per year until the bond matures. For example, if you invest $1,000 in a 5-year bond with a 5% interest rate, the company will pay you back 50% per year and return you $1,000 in 5 years. Number 2, floating rate bond is a type of corporate bond whose interest rate changes based on benchmarks like the US Treasury rate. The floating rate will be equal to the base rate plus a spread or margin. For example, interest on the bond may be priced at the 6-month treasury plus 1%, which means that at the end of every 6 months, the rate for the following period will be decided on the basis of the treasury at that point plus the 1% spread. A 0% coupon bond doesn't pay interest, but instead makes a single payment at maturity that's higher than the initial purchase price. For example, you might pay $850 for a 3-year zero coupon bond with a face value of $1,000, and the company would pay $1,000 at maturity. Number four, a convertible bond is a regular bond but has additional features that it can be converted into a predetermined number of common stock or equity shares. The conversion from the bond to stock can be done at certain times during the bond's life and is usually at the discretion of the bondholder. One of the major advantages of municipal bonds over corporate bonds and treasuries is that it is tax free. Because of this advantage, the yield on municipal bonds typically is much lower than comparable taxable bonds. Let's review the current yields of these bonds. For example, currently a 2-year treasury currently yields 4.5%. A 2-year AAA corporate, for example, Microsoft yields 4.5% versus single A RBC Corp bond yield of 5.2%. In contrast, a 2-year AAA munis yield 3.4%. Why is the muni yield lower relative to the other bonds? This is because it is an after-tax yield. Junk bonds yields are higher. For example, a 3-year double B bond for AK Steel is yielding 7%.
Now that we have discussed bonds, let's discuss certificates of deposit. A certificate of deposit, or CD, is a savings product that earns interest on a lump sum for a fixed period of time. You may ask yourself, how do they differ from savings accounts? Number one, savings accounts are liquid and you can withdraw your money anytime, whereas CDs are illiquid and cannot be withdrawn until the end of the term. Saving accounts also have lower minimums, for example, $300 to $500, whereas a CD requires higher opening deposits like $500 and up. Number two, CDs pay a higher interest rate, for example, 4% versus less than 1% for saving accounts. Here are some advantages and disadvantages of CDs. A thing to note is that they are risk-free and insured by the Federal Deposit Insurance Corporation, FDIC, for up to $250,000 per depositor per bank. What does this mean? If a bank fails or closes down, you'll not lose your assets as long as the amount doesn't exceed this amount. Also, if you do have greater than $250,000, consider multiple accounts and banks. CDs have early withdrawal penalties and banks may deduct months of interest and or part of the principal. So if you do put your money in a CD for a certain period of time, let it sit there till it matures. Here are some rates offered by some banks. Banks compete with each other for customers by offering higher rates. These rates are recent as of July 2024. For example, Marcus by Goldman Sachs was recently offering a 1-year CD for 5.15% versus 5% from Capital One Financial. If you are interested in CD accounts, a good starting point is to ask your current bank about their offerings and compare it versus other banks.
Here is some useful information that will guide you where you can buy or sell equities, mutual funds, fixed income, and other instruments. We will have a more detailed upcoming session where we will go through the opening of new brokerage accounts and buying securities. Additionally, this information is posted in the description below. Some of the more common brokerage accounts used by people are E-Trade, TD Ameritrade, and Charles Schwab. Note that TD Ameritrade was acquired by Charles Schwab and are one and the same. You can buy equities, mutual funds, ETFs, bonds, certificates of deposits, and options on these platforms. If you buy mutual funds or ETFs directly from Vanguard, Fidelity, T. Rowe Price, etc., the transaction cost or commission is free. Certificates of deposits can also be bought directly from banks like Bank of America or Chase Bank. Thanks for joining us today. Please join us for our next session where we will discuss mutual funds and exchange traded funds or ETFs. Feel free to leave your questions in the comment sections below. We are here to help and answer any inquiries you may have. And please don't forget to follow us on YouTube, Facebook, Twitter, Instagram, and TikTok.